What if the story you've been told about America's financial stability is nothing more than a carefully engineered illusion? What if inflation, rising debt, shrinking savings, and the sense that money just doesn't go as far anymore were not unfortunate byproducts of economic cycles, but symptoms of something much bigger, something designed, hidden, and protected for decades? And what if beneath all the official reports, public speeches, and smooth economic forecasts, there exists a $40 trillion shadow vault, a fictional construct of secret liquidity, invisible guarantees, and buried ledgers operating outside the reach of any voter, any audit, any law? Tonight, we're tearing open the sealed door. This is the fictional, dramatized story of how the Federal Reserve, through mechanisms so complex most economists never dare to touch them, allegedly built a parallel monetary universe. A universe capable of reshaping markets, rewriting crises, and creating the illusion of stability while siphoning power upward. Before we dive in, check in with the community. Tell us, where are you watching from? This channel has become a global hub for people who want the unfiltered, high-energy exploration of financial history and hidden systems. And if you're new, hit that subscribe button. This is where we dismantle the comfortable narratives piece by piece, so you can see the full, fictionalized picture of how money, power, and secrecy intertwine. And trust me, today's reveal is one you'll want to remember. Because once you see how this fictional shadow vault works, you'll never look at your bank balance or your government the same way again. To understand the fictional $40 trillion shadow vault, we need to rewind to a moment that, historically, changed everything. 1913, the birth year of the Federal Reserve. The official story paints it as a triumph of financial stabilization, America's answer to recurring banking panics. But behind the scenes, as dramatized in countless books and films, whispers suggest something far more calculated. A small circle of influential bankers and policymakers gathering on Jekyll Island to create not just a central bank, but a long-term architecture of influence. They claimed they were building safety, but what they built was discretion. A system shielded from the public eye, protected from political winds, and nearly impossible to audit. Sound familiar? Every generation since has felt the effects. From the Roaring Twenties to the crash of 1929, from the abandonment of the gold standard in 1971 to the inflation storms of the 1970s, the Federal Reserve's decisions have shaped the wealth, power, and direction of the nation. And each time the narrative shifts, each time policymakers pivot, it's presented as a response to the crisis. A temporary measure, a necessary fix. Sound familiar? Fast forward to 2008, an event often discussed, often analysed, and often misunderstood. The public saw failed banks, collapsing mortgages, and panicked headlines. But the deeper, hidden story, at least in our fictional narrative, was the expansion of unseen emergency lending programs, overnight liquidity windows, foreign swap lines, and special channels never disclosed in real time. Trillions moved, documents surfaced years later, statements were vague, and the machinery kept spinning. Sound familiar? Now bring that forward to today. You feel inflation clawing at your wallet, housing prices stretching beyond reach, savings losing value, paychecks barely keeping up. And so the question becomes, how did we get here? Is this simply the ebb and flow of economics, or the long-term consequence of a fictional system designed to manipulate the supply of money in ways the public can't see? In this dramatized world, the answer lies in a mechanism almost nobody understands. Central bank liquidity swaps fused with the global shadow banking network, a combination so complex it might as well be magic. This is where our fictional story begins to transform. Because while the official narrative talks about stabilizing markets, the deeper fictional implication is that these swaps and shadow banking pipelines created something much bigger, quieter, and more permanent. A parallel monetary dimension, a place where trillions could be created, rerouted, and buried without touching the visible money supply. This is the foundation of the fictional $40 trillion shadow vault. And the most unsettling part? Its fingerprints show up in nearly every crisis of the last 50 years, yet few ever notice.
But here's the part that will shock you. The fictional vault didn't just rescue markets. It became the backbone of global finance, quietly expanding through swaps with the ECB, BOJ, BO, and others, inflating to $40 trillion in synthetic promises nobody voted for. Nobody reviews, and nobody can unwind without triggering a cascade. Who created it? Who designed the structure? Who understood the consequences? You won't believe the name. And the receipt is wilder than you think. To understand the fictional shadow vault, we need to demystify the machinery behind it. Let's start with central bank liquidity swaps. In the real world, these are agreements between central banks to exchange currencies, usually dollars, so foreign banks can access liquidity during crises. In our fictional narrative, these swaps become the cornerstone of a secretive, ever-expanding pool of synthetic dollars. Imagine this. The Federal Reserve provides $1 trillion in dollar liquidity to a foreign central bank. That foreign bank, in turn, provides guarantees or collateral that never touches public ledgers. The money flows into institutional pipelines, investment banks, global lenders, shadow firms, where it can be multiplied through derivatives. This is where the fictional magic happens. Because derivatives contracts based on the value of other assets can create exponential exposure. A $1 billion derivative position can represent $20 billion, $100 billion, sometimes more, in synthetic exposure. In the fictional system, these derivatives act as scaffolding for the shadow vault. Let's anchor this with 5 shock numbers. 1. $1.2 quadrillion, the notional size of the global derivatives market. 2. $16 trillion, the size of emergency lending facilities disclosed years after the 2008 crisis. 3. $4.5 trillion, the Federal Reserve's quantitative easing balance sheet at its peak. 4. $500 billion per day, the 2019 repo market interventions that stunned analysts. 5. $40 trillion, the fictionalized estimate of synthetic liquidity circulating inside the shadow vault. These numbers are real in scale but fictional in interpretation. In our narrative, they combine into a single invisible structure. Now let's break down the fictional steps of how the shadow vault operates. Step 1. Crisis creates opportunity. A market cracks. Bonds freeze, banks hesitate. Liquidity dries up. Public fear grows. But behind the screen, the fictional architect sees the opportunity. Not to stabilize, but to expand control. Step 2. The swap trigger. A foreign central bank requests dollar liquidity. Publicly, it's justified as temporary stability. But in our fictional narrative, the swap triggers a hidden clause. The creation of synthetic liquidity chains built on collateral nobody audits. This collateral might be foreign sovereign bonds, bank guarantees, private institutional assets, derivative portfolios, all marked AAA, all unquestioned. Step 3. Derivative multiplication. This is where the fictional vault grows. Imagine a foreign institution receives $500 billion through a swap. On paper, it's a loan, but through derivatives, interest rate swaps, FX forwards, credit default swaps, that $500 billion becomes $5 trillion in exposure. And here's the kicker. Only a sliver of that exposure ever shows up on formal balance sheets. The rest, it disappears into the fictional vault. Step 4. Invisible backstopping. Whenever a bank teeters, whenever a hedge fund collapses, whenever a bond market convulses, the fictional shadow vault steps in. Not with visible bailouts. Not with congressional approval, but with synthetic dollars pumped through institutional pipelines, stabilizing markets without leaving a public trace. Step 5. Perpetual expansion. Once created, synthetic exposure almost never unwinds. Banks roll it over, governments roll it over, derivatives roll it over. It grows, quietly, endlessly. In our fictional world, this is how the vault reaches $40 trillion. Now, why does this matter? Because in a system built on hidden liquidity, real market signals vanish. Risk becomes impossible to measure. Prices reflect the vault, not supply and demand. And institutions that depend on the vault become too big to question. This is an illusion, the moral hazard. The engineered stability hides engineered fragility. How it impacts you. Even though this is fictional, the narrative mirrors real economic pressures. Inflation that feels worse than the official CPI. Savings losing value faster than expected. Asset bubbles forming and popping faster than ever. a sense that markets never correct naturally anymore. It's the feeling that something unseen is pushing the system because in this fictional world, something is. And the most unsettling idea? If you build a financial system on hidden liquidity, you cannot unwind it. You can only expand it. This is the parasitic cycle, the illusion of prosperity, the engineered calm masking permanent instability. This is the fictional $40 trillion shadow vault. Here's the final fictional warning. The world today is faster, more automated, more interconnected. Algorithms trade billions in microseconds. Derivatives move at light speed. Debt spirals upward without pause. In a system like this, a fictional vault designed in the 1990s or 2000s cannot contain the next shock. It can only delay it, mask it, redirect it. But every delay makes the eventual break bigger. This is the era of borrowed time. Because the fictional vault has a flaw. It requires infinite growth, infinite swaps, infinite synthetic liquidity. The moment it stops expanding, the moment a swap fails, the moment collateral is questioned, the system begins to reveal its true weight. And when the illusion cracks, everything tied to it feels the tremor of mortgages, savings, pensions, markets, currencies. In this fictional narrative, the greatest danger isn't collapse, it's denial. Denial that systems built on invisible mechanisms can fail. Denial that structures built to stabilize can distort. Denial that complexity always hides fragility. So before you go, ask yourself, are we wiser now? Or walking the same path in better suits? If this fictional deep dive opened your eyes or at least got you thinking, share it, like it, and hit subscribe. This community is built on curiosity, skepticism, and a willingness to explore the financial stories nobody else wants to touch. Drop a comment below. What part shocked you the most? And as always, stay sharp. The next chapter is always closer than you think.